Hi, everybody. This is Gary Dean and Woody Dorsey, and this is our market talk for Wednesday, February 8th, 2017. Today, we're going to go over a few things. It's really a lot of ad lib because the markets have been doing what Woody's been anticipating them to do. So we just want to kind of give you a pretty much idea of what we see playing out moving forward. So with that, I'm going to pass this on to Woody, and we'll go from there. All right, Woody. Hang on.
Hey, thanks everybody. Yeah, just wanted to have a little conversation here about this market situation, and I had a question from some subscribers about what's going on with the market, and I've been talking about that we're in this transition zone. Number one, going back a couple of months ago, we thought we could go up into late January, maybe early February. Now we've entered into what I'm calling a transition phase, which is also described as a rollover, meaning the market is trying to turn over and roll down, but it's a process. And another term I've used recently, I was asked about, is a sloppy top. See, the market is topping here, but it's very, very sloppy. It hasn't been able to break down importantly, then it pops up, but then it sets back. This is the season that we're in. Now this will resolve into a corrective decline, but as I said, the decline, when it happens, is what I call a kill zone. Let me talk about that a little bit. That is not due here. Again, I mentioned that usually happens in the almost really in the latter parts of a decline. So we've got to make a top first, which we have done maybe in some indices. We need to have a top, then we need to start to see an indication that we're breaking down, and then within that breakdown, the setup will come where there's a kill zone. We go straight down for a short period of time. Every move has a kill zone, whether up or down. It's like a third wave, an Elliott wave theory, etc. It's a strong trending function. Now, the thing is that in the work that I do the sentiment, as you know, and also the timing is I like to see these things align, and there is not, sometimes people think, oh, you do turning points or this or that, when the kill zone is going to be, what day, what hour. I don't exactly. It's more of a form of the situation, and you have to wait, you have to be patient for the setup to occur, and when a market gets ready to go into a third wave to the downside or a kill zone, there's usually technical indicators, timing indicators, and sentiment indicators. One of the things that's happened here, we've had a few instances of low sentiment, but they haven't been really low. They haven't been like 0%, 1%, 2%. They've been like 11%, 15%, which is typical of a correction in a still ongoing bull market. So if we were getting, 0%, 1%, 2% real shocks psychologically, that would be quite negative. So that part has not come into play yet. And I really want to see what I call a sentiment torque to indicate when that occurs. Now, I mentioned last week, not to get too bearish, because this week had a little bit of a friendly bias, and that in effect, these next couple of weeks in February are very difficult to read here. So this is a situation where it's really great to try to be able to sit back, watch for a signal. Again, my point when I mentioned the kill zone a couple, 3 weeks ago was that I thought the market might be making a high then, but you weren't going to make any money being short anyway.
Right. That's exactly what you said, was that it's going to be really tough to make money on the short side.
And that is, this is an important distinction. And again, for people who are maybe new to my view or what we do in this report is it's about being patient for setups to occur. And I do a kind of diagnosis where I think I try to know when certain things might happen, so you're forewarned. So if somebody had said to you, hey, the market's topping today 2 weeks ago, you'd be thinking, hey, I got to get massively short. But I said that's not the point here. You don't get massively short at tops because it tends to be very, very frustrating. And we have to just keep diagnosing the market. Now it's interesting, I'm going to break into a small section here that I call great traders. So let me give you some real stories.
Hey, Woody, can I pause you for 1 second? Because I just want to go back to what you were just saying, where I think a good way, if I was in an elevator and somebody asked, what we do, I think one of the things I think people don't get is we set the proper expectations, and it's both when to expect something, but also how to control emotions, because at bottoms and at tops, what tends, and you see it on the sentiment end of things, is people get really, really emotional. They get either extremely bullish, extremely bearish. But when somebody is anticipating, say, the kill zone, now if they don't know when that's going to take place, and let's say they're just reading some of our free stuff that we send out, and they're positioning themselves on the short side for the kill zone, right now their emotions are going crazy because they maybe had thought that the original drop from here was to start at a kill zone, but we knew when it was at that low. You were saying don't get too bearish because we have a kind of a bullish week. I know that the technicals on the short term, we're looking for a bounce as well, because we are at some support, and as well as that, we had bullish divergences. So we had the time part that you have that you do was in place, and we also had the technical part. So as much as nothing's changed on the big picture part of things with the kill zone, we set the proper expectations where, if you get really short right now, you're going to be really, really frustrated next week because it's not a bearish week. So I just wanted to kind of throw that out, that it's, a lot of what we do is setting the proper expectations so they can control their emotions on positioning their portfolio.
Yes, very good. And it is important to have a picture of what the possibilities are for the market. At the same time, because we are in this topping process, on a lot of these days where the market's been up strongly one day, it would be a mistake to just go in whole hog and say, oh, this thing's still going higher, man, I want to be in it, because then the market sets back. Because at this stage, you don't want to be aggressively playing the long side except for short-term scalps. Exactly. So let me digress into this, and just for a moment, into this trading, this idea of trading that we're all trying to learn more and more about. And there was one fellow that I was familiar with and worked with his team, who was a very famous trader. Now, I won't tell you who it is, except that his last name was Jones. Now, he would often, like, let's say he wanted to be short S&Ps here. He might be thinking that that's where you want to get positioned, and he would get short. Then he would have to cover. Then he gets short again. He might get short 8, 9, 10 times and get stopped out for a small loss, and then a huge move would occur, and he'd make a lot of money. That's how experienced, very good traders trade. They love to get stopped out all the time for small loss. And that goes against the way that most of us are trained in terms, oh, I want to be right, I want to make a lot of money on each trade. That's not the way the world works. There's another person who's actually the greatest trader in modern history, and I will not tell you his name, but I visited with him and knew him personally. And what he would do is, he's putting on a trade, he would risk maybe 0.75% of capital on the trade. Not 10%, 0.75%, or maybe 1.25% max. And that's the kind of risk allocation he would take, and he would put in his stops right away on every trade, right away, in the same order. Buy me 20 contracts of Swissy, and this is the stop. And he said, very occasionally he'd get stopped out before he'd get the call back on the stop before his original buy order went in. So this just tells you something about risk management with really great traders, that they stay small, they're very careful, they're very risk averse, and but they still make a lot of money over time because they have learned how to trade. Now, I saw something interesting in the paper the other day about this high school basketball team, which has gotten some success because they have applied the some math, like the Moneyball type math. You know, there was a book about the, baseball, and what they figured out is that, and what they do when they play their games is they either take layups or they take three-point shots. They don't try to make the other shots because you get rewarded for a three-point shot. That's a huge difference, right? And a layup is a layup, and they're very successful with that. And it's an interesting way to think about trading. If you see some small, you know, some small trade to do that you think, you know, might work, you know, for a week or 2 days or whatever, you know, it's kind of a layup, you know, where your stop is. You might do that. You might do a lot of those, you know, and a lot of them you'll make a little money. And then occasionally when you get a big move, you get like into a kill zone. That's when you hit the three-pointer. That's when you take the half-court shot. So it's very important. This goes back to what Gary was saying about managing your expectations.
That's an interesting theory.
Yeah, and so what I'm saying here in terms of this, all the profiles we've been talking about, is we're in this in-between transitional, rolling over, sloppy topping type action where there has not been, nor is there a reward right here for being aggressive. And that's just the way it is, folks. I mean, that's where we are. And I still think this can continue for another week or two. I need to see, because I watch it very carefully, I need to see some signals from the market. And breakdowns are good, really negative sentiment is good in terms of a change of the vibrations in the market energy. I'm not going to get into it today, but I'll tell you one of the things I also do, because I've studied this, is I use facial diagnosis. Well, what the hell am I talking about? Well, you know, I know a lot of these people on TV, the talking heads on the pick your show. I've met a lot of them. I've been on the shows or whatever. What they're saying and whether they're laughing or whether they get concerned or whatever, that is another way of diagnosing financial culture. So I like to see them get freaked out when we start to make a decline. That would be a good sign. So there's a lot of little things that I'm looking at. And for now, we just have to accept what the market is giving us, which is not a great deal right here.
Right.
That's really all I want to say.
Yeah. That's a good thing, and it's a, you know, you have to be able to practice patience when you're in this market, because if you don't and you get in it every single day and you're watching it every tick, you're going to go insane and you're going to end up missing the moves that have been right in front of your eyes and something that's been told to you, you know, basically for the last month. And, you know, so you want to have your spots, you put them there, and then you put stops in place that makes you comfortable, and you just, you know, that's it. When we're heading into, say, a bullish week, or we have some bullish divergences, you don't get aggressive on the short side, and it's the same thing on the downside. Is, you know, when you start seeing these things, it's not when you want to press your trade. You want to, you know, sit back and manage it. And if it gets to a point, you could either add to it or, you know, you just let it ride. But you have to know when to get aggressive and when not to get aggressive. And a big part, like we said, is, you know, just being patient on things and setting the proper expectations. So I think that was, you know, a good piece that you were just talking about. It makes a lot of sense.
Okay, so then we'll, you know, keep an eye on the written report tomorrow. I may have a better indication on the timing. Again, every hour, every tick in the market is telling for any kind of a change, but so far, you know, it's pretty messy. Okay.
Right. All right.
Okay,
Woody,
we'll talk to you tomorrow.
Everything, and I'll talk to you tomorrow.
Okay.